All right, greetings, tax nerds. Welcome to the March edition of the International Tax Lunch. I'm Phil Hodgen, and this month we are going to talk about distributions to U.S. beneficiaries from foreign non-grantor trusts. Overly complicated, pain in the neck, but this is going to be a walkthrough for how you do it, including down to how you fill in the forms. And let's go. So what we're going to cover today is a little bit of when do we know that a U.S. beneficiary received a distribution from a foreign non-grantor trust, because distribution means more than just I got money. And then we're going to say, how do we know how the U.S. beneficiary is going to be taxed on that distribution? Because if you step back and think about it for a second, a foreign trust is outside the reach of a U.S. court and a judge. Its assets are overseas, and the trustee is overseas, and the accounting records. So it's impossible for the U.S. to reach out and tax that trust directly. So they got to do the next best thing, which is tax the beneficiary when he or she receives a distribution. So, but let's step back a bit. I'm going to get a little bit meta and say, well, why does all this complicated stuff exist anyway? And the reason is the IRS has two important things they like. They like to know that what you put on a 1040 is right. And the second thing they like to know is you haven't skewed the tax rules somehow to defer the moment of time that you're supposed to pay tax. Let's look at the first thing. A domestic trust is easy for the IRS to audit all the way through the data stack from the time income is received from whoever, on trust assets by the trustee, all the way through till it's reported by the beneficiary on the beneficiary's 1040. So you have the accounting data for domestic trust is inside the United States, accessible by subpoena. There's a 1041 that's filed by the trust every year reporting taxable income and whatnot. Also, this is under penalty of perjury. Throw me in jail if I lie on this thing. And the domestic trustee is within the reach of the U.S. courts. So if necessary, the court can issue a subpoena and say, hey, trustee, come here, give us information. So all the way back to the ground zero, IRS has access to data. Then the trust issues a K-1, so we've got matchy-matchy between the trust and the beneficiary. And then the beneficiary takes the data from the K-1, puts it on the 1040, and that way the IRS can verify that the 1040 is in fact correct. Look at it from the foreign trust point of view. You've got a foreign trust with foreign assets, a foreign trustee, earning income from foreign sources. All the accounting data is outside the United States. It doesn't have to file a U.S. income tax return because it has no U.S. income. The trustee is outside the reach of the U.S. legal system, so it's not as if a U.S. judge can say, hey, show up and bring all of your books and records. And so the trust, as far as the IRS is concerned, is a giant black box. When the foreign trust makes a distribution to the beneficiary, there's no requirement that a K-1 be issued because there's no 1041 to bolt a K-1 to. So the beneficiary just gets money. Now, the beneficiary is supposed to file a Form 1040 reporting, hey, I got some money from a trust. How is that going to be characterized and how is it going to be taxed? This is impossible for the IRS to come and call BS on what the beneficiary put on that income tax return. And this makes the IRS grumpy because they can't verify that frankly, the beneficiary has an opportunity to lie and get away with it, and the government doesn't work that way. So this is the first thing, access to data. The second thing, why we have these special rules for distributions from foreign non-grantor trusts to U.S. beneficiaries is tax deferral. If you look at a domestic trust, it receives income in the current year. The trustee is going to have a choice to either accumulate the income or distribute the income. If the trustee decides to accumulate the income, tax is going to get paid on it in the year that the income is earned on Form 1041, the trust income tax return. If the trustee decides to distribute the income to the beneficiary, then the income is going to get taxed on the beneficiary's tax return, Form 1040, again in the year that the income is earned. So there's no deferral possible, which is the way that the U.S. tax system is set up. Pay now. Look at it from the foreign trust point of view. You have a foreign trust earning foreign source income. and the trustee makes a decision. Shall I accumulate the income or shall I distribute the income? A foreign non-grantor trust is taxed by the Internal Revenue Code like a non-resident alien individual who never sets foot in the United States. So a non-resident alien individual earning income from foreign sources has nothing to report anywhere, and there's no tax possible in the U.S. So the income just accumulates tax-free. So this is bad. And then, so we think about it this way: if income is distributed years later from the accumulation, that's the problem. By contrast, and this is the part that we're going to look at today, if there is income earned and distributed in the current year to the beneficiary, tax is paid on the 1040. The question is just how do we do it? And there are two methods, and we're going to walk you through how the beneficiary is taxed on those distributions. So looking at slide 7 and seeing that it is possible for the trust to accumulate foreign source income and avoid U.S. income tax, if you want to look at it like this, with a little bit of care, love, and attention, it would be possible for a U.S. person to create essentially a roll-your-own IRA, where you can put money into a foreign trust. It'll accumulate tax-free, so the compounding effect of investment returns tax-free is fabulous, and we like it. And then the income would be distributed on the back end, just like an IRA, taxable then, 20 years from now. What's not to like? Well, everybody likes it except the IRS and Congress, so this is why we have the rules that we're going to look at today. So now, this is your tax professional, because that's who listens to these things, and this is what one of these projects looks like to me. And my suggestion is, in stuff like this, don't skip a step, even if you think you know the answer. Just double check your assumption to make sure you're right. So you start off, we're at slide 9. The first question to ask is, what kind of trust do I have? Do I have a foreign or domestic trust? Do I have a grantor or non-grantor trust? The next step we're going to go through is, do I have a U.S. beneficiary? Distributions to foreign beneficiaries are not taxable, but distributions to U.S. beneficiaries are. So if the person showing up in your office and saying, please prepare my tax return, is a U.S. beneficiary, you've got to worry about this. If they're non-resident alien, you do not. The next step, slide 11, is, do you have a distribution? And as I said before, distribution does not just mean trust wrote me a check. Distribution means other stuff as well. So you look for that. And the final thing, which is what we all came here today because we love it, how do you prepare the forms? Finally, what happens if you're late? What happens if you're doing an amended filing? You've got problems. What's your way out? What do the penalties look like? Things like that. So walk through these things one at a time. We're going to spend most of our time on step 4, which is preparing the tax return, but we're going to take a quick drive-by of each of the steps before that. First one is, what kind of trust you have? And is it a foreign grantor trust or a foreign non-grantor trust? And why this matters is it's the same sort of thing where if you're preparing a tax return for a corporation, the first thing you want to know is, do I have a C Corp? Do I have an S Corp? It tells you what kind of tax form you're going to file, 1120, 1120S in that situation, and it tells you who ultimately is going to bear the burden of the income tax. So in our situation, we want to know the answer to this question so we can prepare Form 3520 correctly, because distributions from foreign grantor trusts go into a separate section from distributions from a non-grantor trust. We want to know whether Form 3520A is required. Grantor trusts with a U.S. grantor have to file Form 3520A. Other people don't. And of course, the final thing is, who's going to bear the ultimate liability for the income tax, the grantor or the beneficiary? Slide 16. Foreign trusts, we have these two things, the court test and the control test. Step back and let's just talk about why the tax system works as well as it does, and that's because of force and violence. If the U.S. wants money from you, they say, hey, pay the tax, and if you don't pay the tax, we'll take you to court. The judges in the federal court have this wonderful thing called contempt powers, and the judge will say, I order you to produce the data. and you say no, and the judge says, I'll put you in jail until you come to your senses and do what I asked you to do. And so if you want to step back and look really far at this, they're saying a foreign trust is someone who fails one of these two things, and which means they're beyond the reach of the tax system in the United States and the judicial system to enforce the tax, and therefore we're going to tax you in a whole different way to make sure we collect what we think is the right amount of money. The court test says, does a domestic court have primary supervision over the administration of this trust? The control test says, do we have U.S. people subject to subpoena power by a U.S. court who can be brought into court in order to do the quotes right thing? So if you fail either of these things, you have a foreign trust. The second thing is, now we're going to assume from now on out we have a foreign trust for one reason or another. And this is usually going to, not usually, it will absolutely be necessary for you to read the trust document in order to figure this out. The second thing we're going to figure out is, do we have a grantor trust or non-grantor trust? So these are the only two animals that we can have, and if it's a grantor trust, it is, and if it is not a grantor trust, the only other possibility is a non-grantor trust. And here on slide 17, you have 4 different ways in which a foreign trust may be a grantor trust. And the most important ones for our purposes are the first one. If the trust is revocable, this is by default going to be a foreign grantor trust, and income is going to be attributable to the foreign grantor. That's the one I see most often, and when we're trying to design a trust to be a foreign grantor trust, that's the tool we use most often. But anyway, these are the 4 things to watch out for, and again, this is going to take some work outside of a tax form to figure out what you have. The second step is, do you have a U.S. beneficiary? And I've got to say that usually the answer is obvious. Sometimes it's not so obvious. Slide 19, why it matters. U.S. beneficiaries pay income tax on the distributions. Foreign beneficiaries do not pay U.S. income tax on the distributions. And just as an aside, I'm saying that these foreign trusts have no U.S. source income, just to keep my examples simple. But there's a second category of people who may be at risk for U.S. income tax on distributions from foreign non-grantor trusts. And these are people who renounce their citizenship, or green card holders who've been green card holders for a long time, called long-term residents in the code, and they give up their green cards. And some of these people are subject to tax on distributions from foreign non-grantor trusts even after they opt out of the U.S. tax system. So, slide 20. What's a U.S. beneficiary? I've quoted the words from the instructions to Form 3520. And it says, a U.S. beneficiary is a U.S. person who could possibly benefit from this trust. Most foreign trusts that I've ever seen have a clause in there that gives the trustee and possibly some other person the power to amend the trust to add or delete beneficiaries, sometimes with limits and sometimes without. So think about this situation. Foreign granddad sets up a foreign non-grantor trust for U.S. beneficiaries, grandchildren. And it says, just as they normally do, the foreign trustee has the power to amend the trust to add or delete beneficiaries without any limit on that. Well, me, Phil, am a potential beneficiary of that, because the trustee could find me, one of the 7 billion people on the planet, and say, oh, I'm going to amend this trust, and I'm going to add Phil in as a beneficiary, and hey presto, I'm there. So you can see that when you're thinking about who is a U.S. beneficiary, don't just look at the document. Look at who could possibly be included in the category of a beneficiary. The second group of people to watch out for, expatriates. Some people who give up their citizenship or their permanent resident status are what are called covered expatriates. In general, these are people who, when they give up their citizenship or green card status, have a net worth of $2 million or more. But there's a couple of other categories of people who can be tripped up and accidentally and become covered expatriates. If the person falls into that category when they exit the U.S. tax system on their personal status, there's a mark-to-market tax on them as they leave and some other stuff. But critically, For trust distributions from non-grantor trusts, they continue to be responsible for paying U.S. income tax on the taxable portion of the distributions they receive from any trust, including foreign trusts, even after they expatriate. So someone is no longer a U.S. citizen living outside the United States, receiving distributions from a foreign non-grantor trust, and Uncle Sam says, "Give me some of that." The way they figure out how much Uncle Sam wants is you figure out the taxable portion of the distribution. And for that, you pretend that the person is still a U.S. taxpayer, and you do the math and you figure out what the taxable portion of the distribution is. After that, you apply Section 871, which is the tax rules for non-resident aliens, to figure out what the tax will be. Typically, the tax will be a flat 30% of gross. And there's a withholding rule that says to the trustee, please withhold 30% of the taxable portion of the trust distribution, and that makes sure that Uncle Sam gets the money. So, again, just the warning for those of you who are preparing tax returns: if you have a foreign non-grantor trust and if you have an expatriate, don't assume it's game over and you can put your brain to sleep. It's not quite that simple. Right, step 3. Now, do we have a distribution? When money or stuff comes out of a trust, there are really only two categories well, there are three, as you'll see, categories of things that event can be. So we have this. Trust distributions are cash or property distributed to the beneficiary. That's uneventful. Loans to the beneficiary that are not qualified obligations. Use of trust property by the beneficiary or other people without paying fair market value, and transfers from a foreign trust to a U.S. person through an intermediary. So those are the things we're going to look at. I'm going to ignore the obvious one. I received a $50,000 wire transfer from a foreign trust. That's easy. These ones, loans, use of trust property, and transfer through an intermediary, are the more difficult ones, and the ones that may not necessarily be obvious when the person sits down in front of you and says, do my tax return. First, let's look at loans. A loan is a distribution, with the exception of qualified obligations. Go look in the notice there that I've given you the citation for to see what a qualified obligation is. But in general, it means maturity of 5 years or less. It's a written instrument. It has the right minimum interest rate and things like that. So that is a qualified obligation. That's not treated as a loan, but otherwise, any money coming out purporting to be a loan will in fact be recharacterized as a distribution. The more important and weirder and unhappier part of it is a loan to a related person is a distribution to the beneficiary. So I get a loan, no problem. My dad gets a loan and I'm a beneficiary. I've got a distribution because the loan was made to my dad. The related party rules you're seeing down there at the bottom bullet point, 267 and 707B, with modifications, of course, because why would we just have an untold number of related party rules littered through the Internal Revenue Code where we could just use them willy-nilly without modification? I'm not bitter about that, but unnecessary complexity. I do not judge. Third one, free use of trust-owned property is a distribution. The classic situation that we see in our practice is a foreign non-grantor trust owns a condo in Vail, let's say. Beneficiaries come to Colorado. They go stay in the condo in Vail for a week of skiing. They don't pay any rent. They leave. Use of that condo in Vail by the beneficiary, the U.S. beneficiary, is going to be treated as a distribution at the fair market rental value of that condo. And critically, this also includes use of that condo by a person related to the beneficiary using the 267 and 707B related party rules. So watch out for this. And for what it's worth, in our work, if we have a situation where we have a foreign grantor or a foreign person who wants to create a trust and we have U.S. beneficiaries, we will invariably attempt to use a U.S. domestic trust precisely to avoid this deemed distribution for use of trust-owned property. Because if you look at the equivalent domestic trust that owned a condo in Vail, the beneficiary could go use that place and there would be no tax and no deemed distribution, things like that. So this is just what we do. The final one to look out for is you have a foreign trust and the trustee makes a distribution to somebody else. And after a while, that somebody else makes a gift, and I put that in air quotes, to the U.S. beneficiary. The U.S. beneficiary reports that gift on Form 3520 in Part 4, the last page of Form 3520, saying, hey, I got a tax-free gift from a foreign person, no tax, hey, hey, because the equivalent distribution from a foreign trust would have been taxable. So, and this happens all the time. You think about two siblings, a brother and sister. Brother lives outside the United States, non-resident alien. Sister lives inside the United States, U.S. citizen. There's a foreign trust set up by grandparents. The sibling living abroad takes the distribution, sits on it for a while, and gives it to the U.S. beneficiary, no tax, whereas the doing it the logical way would have imposed a tax. And there's a presumption. And I've got the citation in the regs for that, and it says, if you do one of these things, we're going to presume there's a tax avoidance motive, and we're going to disregard the intermediary and treat you as if you received a distribution straight from the trust. And if you look in the regs, you'll see all the things that create the presumption, one of which is less than 24 months happened between the time the money came out of the trust and the money went to the U.S. beneficiary. So the easiest way, if you're thinking about using this to hit the tax avoidance motive and defeat the presumption, is to wait beyond the 24 months. And this is kind of like, in the partnership arena, where you've got one partner who puts in cash and another partner who puts in highly appreciated property. And the person who puts in the highly appreciated property would really like some cash. And if you wait for 2 years between those events, then the cash can go out to the partner. The distribution is not going to be deemed a capital gain event.
Phil?
Yeah.
Supposing you reverse that process. The brother gives the sister money and then 2 months later receives a distribution from the trust. That work?
Ooh. Okay. Okay. So for those of you, Rufus Rhodes in here asked a question. We have an omnidirectional. No, the opposite of omni. Whatever. What's the opposite of omni? One. Unidirectional, Mike. He said, okay, reverse the process. Let's pretend that I had the situation of first money comes out of the trust to non-resident alien beneficiary who sits on it for a while and then gives it to the U.S. beneficiary as a gift. And I'm putting the word gift in air quotes if you're in the room. And now Rufus is saying, what if you do the opposite, right?
Yes.
So the money comes out of the trust.
The brother gives the gift to the sister, and 2 months later, the trust reimburses, in effect, the brother.
Oh, okay. So what if the brother goes out of pocket for the equivalent amount and says, here's a gift, sister, and sister reports on 3520 and then magically gets reimbursed, in air quotes, by the trust a few months later? Is that a tax avoidance thing? I never thought about that, but it's clever and I like it, and I might try to use that in the future. So there. Okay. So there we go. So we've sort of done our due diligence. So you're in the position to say, yes, I have a U.S. beneficiary who has to worry about all this stuff. Yes, I have a distribution and I have to worry about all this stuff. And yes, I have a foreign non-grantor trust and I have to worry about all this stuff. So let's get down to the tax forms and let's see what's going on here. And here on slide 28 is my process. You start on Form 3520, Part 3, these lines 24 through 28. And this is where you just report the value of distributions received, whether they are use of trust-owned property in kind or loans that are treated as distributions or distributions. At that point, the beneficiary has two choices. You're going to select one of the two methods for calculating the U.S. income tax on this distribution. The default method, the top track, and the actual method on the bottom track. So after you've selected it, you're going to go on, and the default calculations are in Schedule A of Part 3, Form 3520. The actual calculation method is Schedule B. So you'll go through the lines, and we'll do some examples just in a second. And then after you've done that, you're going to know how much is ordinary income taxable in the current year and how much is an accumulated distribution, which we have to do some more math on the accumulated distribution portion of it. And that all of that extra math is going to happen on Form 3520 Part 3 Schedule C, and we're going to use Form 4970 as a worksheet to do some of the calculations for that. And finally, when we've got all that done, we're going to port all of our numbers over to Form 1040. Some of the numbers will be sprayed all over the place. Schedule B if it's interest or dividends, Schedule D if it's capital gain, all that kind of stuff. Some of it will go to Schedule E. And I've also got Form 8960 in there for net investment income tax, because you got to think about that stuff. So the first question is, what method are you allowed to use? You as the beneficiary, when you're calculating the tax on the distribution you've received from a foreign non-grantor trust. The two methods are the actual calculation method. You're allowed to do this if you receive a thing called a beneficiary statement from the trustee. We'll talk in a second about what that is, but basically figure this is a free-form stand-in for a Schedule K1. And you've never used the default method before. The default method says if you're knocked out of the box and you're not allowed to use the actual method, you have to use this other method, the default calculation method. Now here is why the default method is substantially worse than the actual calculation method. Current income, if you use the actual calculation method, you get to treat income according to its character. So capital gain is capital gain, qualified dividends are qualified dividends, and the like. If you use the default method, anything that's characterized as current income is going to be taxed as ordinary income. So you've got a tax rate differential there depending on the type of income that's received. Accumulation distributions. These, with both methods, are going to be taxed as ordinary income. The tax rate is going to be painful, and there's going to be an interest charge placed on top. So both of these methods are treated the same way for the accumulation distribution. The final one, principal, if you use the actual calculation method and the trustee tags a certain amount as a distribution from corpus, it's tax-free, it's principal. There is no such exemption under the default method. So anything that comes out, and if you use the default method, it's either going to be ordinary income, taxable at ordinary rates, or it's going to be an accumulation distribution taxed at worse than ordinary rates. So as a general rule, you're going to try to avoid the default method if you possibly can. Let's look at the rules behind the actual calculation method. We're at slide 31. Again, here's just a recap of when you can use the actual method. The critical bullet point down here is the third one. You have to get this beneficiary statement from the trustee. You got to attach it to a timely filed Form 3520. So if you are late in filing a Form 3520, you're boxed out of this and you're stuck in the default method. What is a beneficiary statement? I alluded to this earlier. I'm not going to go through the details because there is a lot of details, but the two places for you to look to figure out this is what I must include in a beneficiary statement, if you're doing the work for the trustee, let's say, these are the places. Notice 9734, and you can also look in the instructions to Form 3520. More often than not, if we are working with the U.S. beneficiary of a foreign trust, and we are sending little emails and having conference calls with trustees saying, no, this is what we need because we want to calculate the tax. So we're actually guiding the trustee in what to do for the benefit of our client, who's the U.S. beneficiary. But at a high level, just think of this as a K1. But there's no Form 1041 NR for foreign trusts. And so as a result, there's no Form 1041 NR Schedule K1 for beneficiaries of foreign trusts. So they have to make do with a roll your own kind of form. And that's the beneficiary statement. The actual calculation method works like this. Step 1, you report the calculations in that section of the Form 3520. Then you flip over to the next page of Form 3520 and you report the tax-related information in Schedule B. You take all of that to the places that the Schedule B instructions tell you to take it onto the Form 1040, and then you compute your accumulation distribution tax at the bottom of that page of Form 3520 in Schedule C. Once you've got the tax and the interest rates, then you take that number and you flow it over to Form 1040. The default calculation method works like this. Let's look at the behind, why is it here, slide 36. This is here because and we see this a lot, U.S. beneficiary just gets a check and they have no idea what the trust accounting says. For trust accounting nerds, distributable net income, undistributed net income, and corpus. How does this allocate it amongst all of these things? Who knows? Sometimes not even the trustee will know because the accounting records are inadequate to do the calculation. So if the beneficiary is in the dark, well, then the IRS is certainly in the dark, and they won't know how to verify that the beneficiary's reporting of this distribution is correct as between DNI, UNI, and corpus. So we have a little formula. We do some simple math. The result of the formula is that the entire distribution is allocated to ordinary income, accumulation distribution, or a combination of the two. And it's really simple. You look at the previous 3 years of distributions, multiply that by 1.25, then divide by 3, and you get an average. And this is your over-under. Under is all ordinary income. Above that is going to be an accumulation distribution. So pretty easy to figure it out. Tax rules that apply to both methods. The accumulation distribution computations work identically whether you use the default method in Schedule A or the actual method in Schedule B. We're on slide 39. You use Form 4970 as your worksheet, and then you'll take an accumulation distribution tax from the bottom of Form 4970, port it back to Form 3520, and then you'll do some interest calculations on that. And then you take that, the tax plus the interest, over to line 62 of 1040. So the important thing to remember here is the accumulation distribution does not go into adjusted gross income to compute taxable income and your regular tax. Only the tax liability on the accumulation distribution rolls over to Form 1040. Net investment tax, this may or may not be around depending on what Congress does this year of our Lord 2017, but here's how it stands right now. The net investment income tax does not apply to accumulation distributions simply because the IRS hasn't figured out how to write the regs yet. It will, however, apply to current income distributions from a foreign non-grantor trust. Well, okay, with all of that, let's get into the forms and some examples, and I'm going to give you a ridiculous example to start with just to demonstrate some points. So on slide 42, here is my example. December 31 of 2015, Dad makes a trust for his U.S. kid, puts $100,000 into it. 1 day later, on January 1, 2016, the trustee distributes all of the trust assets to the U.S. citizen kid and then terminates the trust. Doesn't issue a beneficiary statement, so we're stuck with the default method. What do? Well, for both methods, we report the distribution the same on slide 43, and we've got $100,000 and no big deal. Actual method. Well, let's pretend, I said assume there's no beneficiary statement, but let's pretend there is one. What happens in this case? The answer is that the trustee has issued the beneficiary statement and has tagged the entire $100,000 as corpus because in 1 day over a public holiday, there's been no chance to earn any income on this on the corpus of the trust. So line 43 says that, and there's going to be no income tax on your beneficiary. For the default method, 100% is going to be taxable, but how? And here, I'm going to walk you through the rules are ambiguous, or the way that they wrote the line instructions are ambiguous, or something. But I see two possible outcomes when I look at the calculation of the tax result on this $100,000 distribution a day later. Um, and so the literal reading of the line descriptions on Form 3520 says that we have 62,500 of ordinary income and 37,500 of accumulation distribution. So this is, if you read Form 3520 the same way as you read the Old Testament, that the world was built in 6 days and is 6,000 years old, this is what you get. The second thing is to look at the intention behind the default method. And if I look at the intention behind the default method and say, well, the IRS really didn't design this form pretty well and they left out a word to really confirm what they meant, then the entire $100,000 would be an accumulation distribution. So let me show you what I mean. So here we've got the world was created in 6 days version of Form 3520. Line 31, we start with a $100,000 distribution 1 day after the trust was formed. Line 32, the number of years the trust has been a foreign trust. If you read this, they say a day is as good as a year, so it existed for a day in 2015 and the day existed for a day in 2016. So the trust has been in existence for 2 years. Line 33, here's where we come to the ambiguity. Enter the total distributions from the foreign trust during the preceding 3 tax years, okay, or during the number of years the trust has been a foreign trust if fewer than 3. So look at that parenthetical. Our trust has been a foreign trust for fewer than 3 years. It's been a foreign trust for 2 years, in fact. So what this is telling us on line 33 is enter the total distributions received in the current year and the prior year, because these are the years that the trust has been in existence. And so this leads me to an anomalous result. We are including the current year distribution in order to compute an average, which is supposed to be an average of prior year distributions. And it doesn't make a lot of sense to me that you use a current year distribution if what you're trying to do is compute a prior year average. Nevertheless, this is what the form says, so let's follow along what it says. Line 34 is math multiplied by 1.25. Line 35, again, we have this weird parenthetical. Average distribution. Divide line 34 by 3, or the number of years that the trust has been a foreign trust if fewer than 3. Well, we've got 2, remember? And again, we're trying to compute an average based on prior year history, but we're using the existence of the trust in the current year in order to compute the prior year average. But we believe what the form says in the parenthetical, and we do the math and divide by 2, and we have 62,500. Line 36 says treat this 62,500 as ordinary income. Line 37 says treat the rest of it as an accumulation distribution. So there you go. Anybody who's listening who understands this better than me, please help me out. This just seems dumb. But let's go on to, I know what they meant, they just didn't say it right. So let's be courteous to the person who designed the form. Maybe they figured they didn't have enough space in the form, or maybe they just I don't know. So we start at the top, again, with our $100,000 distribution, line 31. Line 32, again, it's been a trust for 2 years. Line 33, enter the total number of distributions received from the foreign trust during the 3 preceding years, or the parenthetical, or during the years that the trust has been a foreign trust. The default method, as near as I can tell, the first time the IRS talked about it was in Notice 9734. When they didn't call it the default method, they called it the default treatment. And so if I look at it, the intention behind it is to look at historical averages and use historical averages as the over-under. And so if we say, well, this is the intention of the default method, to look at history in order to, and then apply history to make a judgment on this year's activity, it seems to me that that parenthetical, which reads now, or during the number of years the trust has been a foreign trust, should really say, or during the number of years the preceding years the trust has been a foreign trust. So in other words, we should have 1 year that was a preceding year. We look at what was that 1 year, and that was 2015 for us, which was 0. So in this, applying the interpretations, we would say 0 is our baseline for calculating the over-under, and we move on. Line 34 is multiplied by 1.25, still 0. Average distribution, divide 34 by 3, or the number of years that the trust has been a foreign trust. Well, again, I think that the parenthetical, the number of years the trust has been a foreign trust, should really read, or the number of preceding years the trust has been a foreign trust. I mean, the same idea, but 0 divided by anything is still 0. And what that results is that the entire thing is an accumulation distribution. So this is my alternate interpretation, applying what I think is the philosophy behind the default calculation method. It's worse for the taxpayer, so I'm a big believer in the literal interpretation of the Old Testament, and we're going to use the less bad solution for the client. Slide 48 is just I threw something together with some more explanations. I'm going to skip it over. Please, if you know anything more than I do, or you have other ideas about how this would work, let me know, because I'm confused and it's a little bit strange. In fact, if you go, let's take even one more extreme situation. Let's say that Dad created the trust on December 31st, and then the trustee distributed all of the money on December 31st. Let's go backwards in time to slide 47. The instructions to Form 3520 Schedule A for the default calculation method say, for line 32, if this is the first year of the trust being in existence, do not complete the rest of Part 3 of Form 3520, which means you don't go into any calculation of allocating this distribution between ordinary income and accumulated distribution, which means that the distribution in the first year must always be corpus distribution, which is an anomaly, but it seems logical to me because in the first year it's not going to have a lot of chance to accumulate a lot of income anyway. So, again, these are extreme situations. In our lives, we see, in fact, the opposite. Somebody comes in and says, here's a trust that's been in existence since 1968. It's been accumulating all the income, and now they want to make a distribution. So we have a problem on the other side, not these extreme examples. But I show you this example because I want to show where the logic of the default method kind of breaks a bit. But slide 49, let's move on to a more realistic example. So let's say we've got a trust, and the trust was created in 2012, and we have this distribution pattern that I show you on slide 50. So foreign non-grantor trust, U.S. beneficiary, been in existence since 2012, and we are working on the 2016 income tax returns right now. So what do we do? I'm going to skip over the first part where we say, here's the distributions we received in the prior year because it's the same as always. I got $100,000. And we're going to go first to the default method of calculation. So we know that we received $40,000 in the current year, 2016, and that goes on line 31. Line 32, number of years that the trust has been a foreign trust, see instructions. It's all the years including the current year. So we've got 5, 12, 13, 14, 15, 16. Enter total distributions from the foreign trust during the 3 preceding tax years. Now in my example, I have 3 preceding tax years. So I'm going to add it up as $10,000 plus $20,000 plus $30,000 equals $60,000. This is what was received in the prior 3 years. Line 34 multiplied by 1.25, we get 75,000. Divide by 3 on line 35, and we got 25,000. And so what this means is that the first 25,000 of this 40 grand distribution is ordinary income, and the remainder on line 37 is going to be an accumulation distribution. So this works pretty cleanly. So once you've got a trust that's been in existence for a while, the default method is going to work just fine. We go down we've got this $15,000 accumulation distribution, and we go down to Schedule C, and we say, all right, how is this Schedule C, $15,000, how is it going to be taxed? And line 49, we have 2248 of accumulation distribution tax. We'll see the Form 4970 in a second. But then to that tax, we have to add an interest charge. Line 50, 2.5, if you remember from Schedule A, that came from line 38. And in the Form 3520 instructions, it says, here's a table, look up 2.5 in this table and tell me what the decimal fraction is to the right of that, and that is your interest rate factor that you do the multiplication on. And so there you go. We have $181 of interest. The total tax is $24.29, and off we go to the races. We're in good shape. That's the total tax that's going to go to line 62. I give you the top of Form 4970. This is pretty mechanical stuff that you just put in here. And the critical thing that you're going to watch for is line 11, the number of earlier tax years to be taken into account. The meta thing here going on is the IRS is asking, what are all the earlier years of this foreign trust where there is undistributed net income? So in our case, since the earliest in time is when the trust was formed, I'm putting in 4 there just for kicks. And also not just for kicks. If you look at section 666D, it says, if you don't know the earliest year when undistributed net income was actually accumulated, you just go back to the beginning of time of the trust, and that's where you start. So you're going to default to the beginning of the trust for this number. And we'll show in a second on the next slide how this number becomes very important to the actual tax bill that the beneficiary is going to pay. So here's where all the fun and the math happens. Lines 14, 15, 16, this is all very mechanical stuff. The idea is you're going to take a number, which is shown on line 15, which is the throwback amount. You're going to add it to actual taxable income in those relevant years. You're going to calculate the tax difference. What did you report on the trust, on your tax return, the Form 1040 during that year, and what was your tax bill? What would have the tax bill been had you included the throwback amount? Do the math, and line 19 shows the difference, and this is going to be the difference amount. We take this line 19, which is the additional tax because of the accumulation distribution, total it all up on line 24, divide by 3 to get an average, and then you multiply it by the number of years on line 11. So the number of years for this trust that has been in existence and actually accumulating income, or the possibility of accumulating income. So in our case, we did the math multiplied by 4. What would happen if the trust had been set up in 2011 and started making distributions in 2012? Well, we'd multiply by 5. That would kind of make a difference to the tax bill, wouldn't it? What if it was set up and it was 6 years old, 7 years old, 12 years old, 15 years old? You can see where all of a sudden the accumulation distribution tax becomes punitive. And there's something stuck in my mind. I don't remember where. Don't quote me. I'm probably wrong. But there's something somewhere in the code or the regs that says if your accumulation distribution tax is greater than 100%, that's your cap. So, and I looked for it this morning. I couldn't find it. So.
Yeah, I think it's there. I recall the same thing, but the killer, of course, is the state tax.
Yeah, okay. Rufus says he remembers the same thing being there, but the killer being the state tax, which doesn't necessarily have that limit on it. So you might have a tax in excess of the distribution you receive. Slide 55, you're going to take, in our calculations, remember we had $25,000 of current income. That goes through Schedule E, and because I'm lazy, I didn't do the Schedule E, and I just ported the number over to line 17 of the Form 1040, where it goes into your AGI, so you can calculate your tax. And then on slide 56, we have the total distribution, including the total accumulation ADT, accumulated distribution tax, on line 62, and that includes the interest charge. And so you can see how even though the accumulation distribution didn't get included in AGI, you still paid the tax on it. All right, having told you all that wonderful stuff, let's talk about fixing problems, and then we'll wrap it up. First one is, here is a way where if you've got one of these old trusts that's been accumulating forever, how are we going to start decanting money out of here with the least amount of pain? And so here we're going to go straight to slide 60. And here's a little table I'm showing you where we've got a trust that's been in existence forever. And it starts by, in year one, distributing $5,000 to the U.S. beneficiary. We go through our Schedule A, a default method calculation, and we figure out that the entire distribution is accumulation distribution. Year two, we increase the distribution by 12%. And we do our math, and we figure out that the allocation now is $2,083 to ordinary income and $3,517 to accumulation distribution. In year three, the trustee increases the distribution by 12% again. We've got the allocation of most of it to ordinary income and the lesser amount to the accumulation distribution. And by year four, we have everything is going to be ordinary income. There's going to be no accumulation distribution. So you show in years 1 through 5, every year the distribution is increased by 12%. You see what the results are, that we're able to get $21,000 out of $31,000 of the distribution treated as ordinary income, which is not good, but it's less bad than having accumulation distribution. So let's go on to slide 61, and I've got the math run out through year 15. And I've collapsed years 4 through 14 into a single line item. But you can see that over 15 years, we've got the vast bulk of the distribution treated as ordinary income. And only those first 3 years do we have accumulation distribution subject to that horrible tax that we did on Form 4970. Now, I'd like to tell you that I used advanced calculus and algebra to figure out the 12%, but in fact, I created a spreadsheet and just by brute force put in annual compounding rates until 12% worked. So I'm a lazy mathematician. So if you have one of these trusts, and if the trust is going to be in existence forever or a long time, this is one way to do it. Just start decanting money out, and by year 4, you're going to be in the ordinary income stage, and it's going to be less bad for the U.S. beneficiary. Another way to do it, if you are able to terminate the trust, you remember I said that the default method only works, once you've screwed up and you've put yourself into the default method, you're stuck there forever. Well, there's an exception, and the exception is for the year of termination of the trust. And a really important thing that took me a long time to understand, how the trust beneficiary reports the distribution for income tax purposes on his or her 1040 has no impact on the trust accounting at the trust level. So the trust can be happily doing all of its accounting with distributable net income, undistributed net income, corpus and all of that fun stuff, and have bulletproof accounting at the trust level. And the beneficiary can be reporting using the actual method, the default method, or anything. It doesn't matter. So here's what you do. Somebody's locked into the default method. So we say the trust is going to terminate. And in that year, the trustee gives the beneficiary an accurate beneficiary statement, and the beneficiary can rely on that and report using the actual method. So this may be better. For instance, liquidate all the assets and get capital gain, and you have long-term capital gain applied to it, things like that. So this is another thing to do. In addition, although it's not on the slide, remember that how the U.S. beneficiary is reporting the trust distribution and paying tax on it has no relevance to the trust accounting at the foreign trust level. What if there is a foreign beneficiary as well as the U.S. beneficiary, and the trust level accounting can show that all of the taxable portion of the trust was carefully decanted out to a foreign beneficiary in year one, and in year two, a distribution was made to the U.S. beneficiary, and we can adequately account for the fact that this is all either current income or corpus. Then we've minimized the trust impact, the tax impact on the trust. I can't even talk. We've minimized the tax impact on the beneficiary by decanting all of the horrible income off to the foreign beneficiary first. Finally, penalty risks. The penalty risk for filing a Form 3520 late is the greater of 10 grand or 35% of the trust distribution. More fun stuff. The statute of limitations doesn't run on that tax return for that year at all until the 3520 is filed by the beneficiary. You can, and we do, use the reasonable cause procedures to reduce or eliminate the Form 3520 penalties. Extra kicker here. You remember how right at the start I said, data transparency is really, really important to the government in this situation. If you do not provide backup data to the government to their satisfaction, Section 6048C2 says the government can treat the entire distribution as an accumulation distribution. So that's an additional stick they have to beat you with. Your options are streamlined procedures, OVDI, or just file and use the reasonable cause procedures as you choose. And that obviously is a complex analysis to figure out what's the least bad way to go. With that, I've come to the end, and as usual, my handy-dandy disclaimer. I just want to emphasize I'm probably wrong about most of this stuff. These slides are out of date because I made them this morning, or both. So please go find somebody to help you. Foreign trust stuff is probably as difficult an area as anything that we work with the exception of PFIX. And so it's not easy. So please get some help. Choose us. We'll do it. And there I am. And we've come to the end. So thanks for participating this month. Next month, we'll have another one, second Friday of the month at noon Pacific time. Talk to you later. Bye.